Good morning, everyone. Thank you for joining us on the first annual Farm Transition Appreciation Day, along with the Farm Management Canada launching of the Farm Transition Guide, which you can find on their website at farmtransitionguide.ca. Right now, we are here for tax considerations for intergenerational farm transfers, presented by Earl Pollock, a certified farm advisor from Farm Life Financial, and Matt Holmes, CPA, founder of Holmes CPA and Tax Advisors. This presentation is pre-recorded. However, we are here to address questions live at the end of the presentation. We invite you to use the Q&A function at the bottom of the screen to send your questions to us throughout the presentation, and we'll be responding to them. Matt and I are going to be taking turns speaking during the presentation. I'm going to kick it off now. You may have had a chance to meet the Hunter family on earlier presentations this morning, but for those that have just joined us, I'm going to give you a brief introduction. The Hunter Farm is a dairy and cash crop operation in southern Ontario. They own 500 acres and rent another 500, and they milk 120 head of dairy cattle. The Hunter family consists of Mary, who is 80 years old, and she is the principal owner of the farm. She and her late husband, Jack, inherited the farm from her family in the mid-1900s and had one son, Bruce, who grew up on the farm and worked alongside his father for his entire life. Bruce is 55 years old, and he and his wife, Susan, have lived on the farm and raised their 3 children. They are Matthew Hunter, who is 30 years old, Maggie Hunter, 28 years old, and Mark Hunter, 26 years old. Mark has worked on the family farm for his entire life, while Maggie left the farm to attend the University of Guelph, and after graduation has worked on another dairy farm but wants to come home to work with her brother and father. Matthew lives about 2 hours away from the farm with his wife Sarah and their 2 children. He has no interest in farming but would like the opportunity for his children should they want to farm later in life. The family identified certain values and goals that we need to consider. One is farm legacy, so they want it to stay in the family. Family harmony, their relationships, very important to them, have good relationships with each other. And finally, the financial security is an important segment of this plan. Discussion points that we'll be going through with the family will be the transition options, looking at what is the optimum way for this transition to happen. Looking at ownership structure, is it corporation, is it partnership, or sole proprietorships, depending on what options they want. Then looking at equalization methods, wanting everybody to be treated fairly throughout this process and with the end result. Tax planning being a very important part of this as well for each generation. I'll turn it over to Matt now for the next few slides.
Thanks, Earl. Just want to go through a slide here, just outlining the properties that are owned, just to be able to set the stage and kind of demonstrate kind of how this transition plan was to occur and the various considerations applicable. So Mary had some personal assets, home farm, 500 acres, worth about $6.5 million. Principal residence of assessed at about $800,000 with 1 acre of land. Total personal asset value of $7.3 million. Then they had the land and assets in the corporation as well. Land worth about $6.5 million in the corporation. Quota at about $2.5 million. Equipment appraised at about $800,000 and livestock at $600,000. Total asset value of $10.4 million, with about $1.5 million of debt existing in the company. You know, if they had to actually realize a full fair market value realization and pay tax, you'd be looking at about $4 million of tax on that. And definitely not an option that the farm could afford, not one that the family could afford to actually experience. So certainly was a need for some real proactive planning. And even if they did nothing, you know, they were and relied on what we'll get into later in terms of intergenerational rollovers, The estate was looking at a probate exposure of up to $250,000 as well, just with no proactive planning. So when we get into looking at transition planning, there's a lot of tax rules that come into play that will often, shape and craft the transition plan and to some extent, certainly as it relates to tax. One of the things we look for is the availability and eligibility of intergenerational rollovers and allowing properties to pass down to the next generation tax-free. We also look to the eligibility and availability of lifetime capital gain exemption as well. Certainly they're available for qualified farm property, as well as shares of a family farm corporation and partnership interests. Everybody has just over $860,000 of lifetime capital gain exemption available and $1 million as it relates to farm property. So there may be benefits to be able to realize those exemptions and use those exemptions as part of the transition plan. We also want to make full use of any principal residence exemptions as well to the maximum extent possible, given any residence is completely tax-free. So we want to make use of that where possible. So just talk a little bit about intergenerational rollovers. And typically they're available where there's a transfer from a parent to a child or from a grandparent to a grandchild. Land and depreciable property is eligible. And as long as the child is actually a resident of Canada, if the child is not, if they're, say, in the US, they're actually not eligible for this rollover treatment. Principal use of the land is critical to being eligible for this rollover. As long as the property is used principally in a farming business, so that generally means more than 50% of the property, the land base, as well as during a period of time of 50% of the ownership period, the property must be used in a farm business. Has to be used by a qualified user, which can include a parent, spouse, common law partner, child, or grandparent, and they must be actively engaged on a regular and continuous basis in farming. Interests in family farm partnerships or corporations will also qualify for the rollover and be available for a possible tax-free transfer. There is a lot more qualifying criteria that's a little more specific and in-depth as it relates to the interest in a family farm partnership or corporation. You really have to get into looking at specific assets that exist within that structure or that entity, and making sure that it's on side in terms of the criteria. Just as an example, a qualified farm corporation can qualify for the rollover as long as more than 90% of its assets are used in active farming operations. So you really have to watch and make sure that other assets on hand that aren't used in farming don't disqualify the corporation for rollover. So assets could include investments, could include real property that's used as a rental that doesn't qualify as active farming assets. So in this particular case, we were looking at, in terms of the Hunter family, their assets, they didn't really have any other assets in the corporation, so the corporation did potentially qualify for this rollover. And then getting into the lifetime capital gain exemption, it'll be available to property that belongs to the individual, spouse, common law partner, or individual if they're a member of the partnership. In this case, if the real estate is used in a farm business that's carried on by either the individual, spouse, common law partner, child, or parent, or a family farm corporation or partnership that includes one of those qualified users as an owner, then it would be potentially eligible. The key criteria for the lifetime capital gain exemption, it often depends on the period of ownership as well and when it was acquired. So any farm property that's acquired prior to 1989, the test is that the property is only used principally in a farming business for at least 5 years. And if you met that test, then it would qualify for the exemption. In subsequent to that, any property acquired after 89 or 89 and later must be farming income must represent the chief source of income, so it must exceed income from all other sources in at least 2 years of ownership. And just a key point: each individual again is eligible for up to $1 million on qualified farm property. Principal residence exemption, like I said, you want to try to maximize this as much as possible. When looking at transition, if an individual occupies a residence on a regular and continuous basis, that residence will be eligible for tax-free treatment. They'll get the principal residence exemption. One key point is that only one residence per year of ownership may be designated. So if you've got a home and cottage, you're only going, and you own that both residences through the same period of time, you're only going to be eligible to designate one in any particular year. It is possible to make partial designations between properties. So if you own both properties for 20 years, you could actually designate 10 years of ownership to the cottage. You could designate 10 years of ownership to the principal residence or the house, and claim partial exemptions. Generally, it's beneficial to designate based on the biggest gain per year of ownership. Another rule that we have to work within is that the principal residence exemption is generally only available to include the house and 1 acre of land. There are potential exceptions to that rule. Generally, if there are municipal restrictions in place that prevent or restrict the lot sizes or prevent severances, then it could be possible to include more land in that. But it's one of the key criteria is that the Act outlines that a house must be, for the land to qualify for principal residence exemption with the house, it must be necessary for the use and enjoyment of that house. So if there is a restriction that prevents you from separating land from the house, it might be possible to claim more land as part of that exemption.
Okay. The next area that we're going to be looking at are presenting the various transition options to the family. The first one being status quo. Mary leaves property to Bruce, and then Bruce in turn leaves his property to Maggie and Mark from his estate. So, so everything being transferred through the will and the estate itself. Next option would be to gift to generation 2, so from Mary to Bruce, and then from Bruce to Maggie and Mark. Mary would gradually do this over time to Bruce, and Bruce would gradually gift interest in the corporation over to Maggie and Mark self. Third option would be a controlled sale, where Mary chooses which assets to gift and which to sell. Bruce would freeze interest in the company and gifts interest in other farming assets over time to Maggie and Mark. Now, I'm going to deal with each of those individually to look at advantages and disadvantages. So again, this status quo, the property is left to Bruce from Mary's estate. Bruce leaves his property to Maggie and Mark from his estate. The advantages of this method would be it qualifies for the tax-free rollover on death if the property remains eligible. It's a simple approach, no change required or needed to wills. It would just follow whatever is in the will. Use of mom's exemption on death to increase the cost base is likely, not necessarily, but in this case it would be. Use Bruce's exemption on his death, so you would see an increase in that capital gains exemption. Equalizes assets between the farming children, and Mark can eventually leave farm property to his children. Disadvantages of the status quo: the assets may not qualify for rollover on death, all depending on some of the points that Matt was making previously. The rules can change. We all know that Canada Revenue Agency do put forward changes every so often, and it could impact on how this happens. Probate cost exposure, you saw from Matt's slide, they're up to $250,000 potentially in probate costs going this method. No certainty or planning for Maggie and Mark with this plan itself. May not meet Mary or Bruce's income for the long term. And there could be unintended asset division that could happen depending on how the wills are written. And a way to equalize non-farming children needed. It does not do that in this case. And there is no pathway for Matthew's children to come into the farm that is through a tax controlled, at least, pathway. Looking at the gradual transition, this is where Mary can gradually gift property to Bruce, and then Bruce gradually gifts his interest over to Maggie and Mark during his lifetime. Advantages on this one, can transfer property when confirmed to qualify for tax-free rollover, can elect to use capital gains exemptions during lifetime to increase the cost base available to the next generation, provides certainty to Maggie and Mark about future ownership, reduces probate exposure, all depending on what percentage of the assets have been gifted already. Disadvantages may not be quick enough to avoid estate realization. Just all depends on how fast things happen. Assets may not qualify for the rollover on death, all depending on some of the rules that Matt covered previously. Rules again can change. Probate cost exposure for the non-gifted assets. There's still some uncertainty for Maggie and Mark. And again, it may not satisfy Mary and Bruce's income needs where full gifting occurs. And there still needs to be a way to equalize non-farming children coming into the operation. No pathway for Matt's children to farm either. Now looking at the controlled sale, this is where Mary chooses which assets to gift to Bruce and establishes a purchase price on others. Bruce gradually gifts and sells interest over to the farming children during his lifetime. He can gift more shares to Mark to compensate for his sweat equity. And he can freeze ownership of asset interests to avoid increase in value of Bruce's share. Advantage of this one, can transfer property when confirmed to qualify for the tax-free rollover. Stops the tax-free or tax creep on shares. Can elect to use the capital gains exemption during lifetime to increase cost basis or on death for any remaining property. Provides certainty to Maggie and Mark and reduces probate exposure. Does provide ongoing income for Mary and Bruce. Under the disadvantages, may not be quick enough to avoid estate realization or full estate realization. The assets themselves may not qualify for rollover, depending on the rules of the day. And the rules, as I said, can change again over time. Probate cost exposure for those assets that do not get gifted or purchased by Bruce. Still some uncertainty for children, but less with a plan in place. And they need an equalization plan with this for Matthew.
Yeah, so I'll just cover in the again the tax considerations that that will go into this transition plan that we need to take or be considering, I guess. As I said, generally it's advantageous to maximize use of the principal residence exemptions as much as possible. If transferring during a lifetime, you know, Mary may have some concerns around giving control over her house, and you know, if she gave her house over to a child, could they boot her out the next day? So oftentimes what we do is we make sure that there is a either a life interest or a right to occupy available to her, so that just ensures that she's got protection and she can continue to use the residence. But you know, if the house is being transferred with the land, then we want to maximize use of the value of that residence exemption and make that designation. Secondly, you know, we'll consider using and maximizing use of the lifetime capital gain exemption on the transfer. The benefit of doing so is it's going to increase the cost base of the land. So what that'll do is it'll reduce a future capital gain for the next generation and ultimately reduce the amount that they have to pay tax on. There are some pitfalls, though, to be mindful of, and just, going ahead and using an exemption. We have to watch for the impacts of alternative minimum tax. So anytime there is a large deduction claimed, such as which is the case with an exemption, such as a lifetime capital gain exemption, the government imposes this thing they call minimum tax. And it's a prepaid tax that can carry forward and be available to offset future income taxes. But it can be a large outlay initially. On $1 million exemption, it could be up to $55,000 of tax. And of course, that's available to offset future tax. But if somebody doesn't have a regular income stream that's taxable, or a much reduced income stream, then the ability to use that alternative minimum tax may not be there. Also need to watch the impacts on income tested benefits, such as old age security and guaranteed income supplement. If Mary's dependent on OAS and guaranteed income supplement, certainly claiming an exemption in the first year will eliminate that benefit. And we do also have the ability to spread capital gains over up to 10 years in this case by using a capital gains reserve. But again, you have to make sure that's balancing the whole idea of being available or having the availability of old age security and guaranteed income supplement as well. It might actually be a better result to trigger this gain in year one, pay minimum tax, lose OAS and GIS for a year, but then for the next 10 years, she'll have her OAS and GIS. Alternatively, we often look at spreading the exemption over a period of 10 years, minimizing that alternative minimum tax, but that could also limit her ability to claim income supplement or old age security. So we have to be very careful with that. If once we've maximized the use of the principal residence exemption and the possible use of the lifetime capital gain exemptions, the next benefit is to try to minimize tax by using intergenerational rollovers for the balance of the farm property. Again, that may not be the goal of an intent of a particular person. Certainly in this case, Mary didn't need any additional proceeds from the sale. Had she needed more proceeds above her exemptions, it would probably trigger capital gains that she'd have to pay capital gains tax on. So in this case, in the case of the Hunter family, we were looking then at using the intergenerational rollover for the balance of the property. An ownership structure consideration. So oftentimes the next step in this transition is also looking towards the next generation. How should they own the property? How should they own the farm and carry out their operations? I mean, in this case, they were already operating through a corporation, so it's really made sense to continue to do so and not change anything from that sense. But when they're transferring assets and ownership of assets, one of the goals is always to keep things as flexible as possible. So in terms of personal assets, we may not necessarily want to put personal assets in the corporation. We want to maybe keep them personal, and I'll get into that in a little bit. But the other objective, of course, is to minimize ongoing income tax. And oftentimes corporations are set up because they do have preferential tax rates available. So one of the things we'd look at is if the farm is producing good income, and let's say they're using that income to pay down debts on the farm. Oftentimes using a corporation is a good way to do that because corporations are taxed typically at 12.5% tax on the first 500,000 of earnings. Whereas, the individual rates, if that income was being reported individually, it could be, more than 40% tax, as high as 53.5 potentially, or even higher. So oftentimes corporations do make sense for that purpose. As I said, preference might be to keep the real estate out personally. The reason for that is if Bruce is looking, or if the next generation is looking at a future transition, it's often better and easier to be able to pass property down that's personally held as it relates to personal real estate property. If the asset's in a corporation, it could make sense to pass that to the corporation if the next generation has to actually pay for it. But it's very difficult to try to pull real estate out of a corporation later without income tax. It's possible to transfer it, from a corporation to another corporation as long as generation one, or in this case, Bruce, generation two is around. But once Bruce is gone and you're dealing with siblings, trying to move properties from corporation to corporation without tax is almost impossible. So for that reason, we like to try to recommend keeping real estate property out personally if possible. And it just makes for an easier transition later. I'm just going to go through a little bit of the comparisons of partnerships versus corporations in this case. Some of the advantages of partnerships is they're flexible in terms of maintenance. There's less compliance costs. They don't have to file a separate corporate tax return. They don't have a corporate minute book they might have to maintain. So from that perspective, sometimes there's less compliance. There's often, it does allow for easier exit and entrance of partners as well. And there's certain rollovers available if you need to dissolve a partnership that aren't available through corporations. If there's losses in the farm, they can be allocated directly to the partners, and they can often offset other sources of income they have, subject, of course, to the loss restriction rules, farm loss restriction rules that are available or in place. So oftentimes in cases, if there are losses, it could be better being in a partnership. Some of the disadvantages, as a partnership earns income, it's allocated to the partners and it's taxable directly to them at their marginal rates. So there's no ability for tax deferral. Really, the only ability that exists is in pre-buys. It can be as complicated at times as corporate reporting. There are partnership returns available that have to be filed if they exceed certain thresholds. Partnership law is a different form of law that is applicable. And so sometimes they can be just as complicated. The other thing is with partnerships, there may not be limited liability the way there is with corporations, and partners participate and share liability with other partners. Corporations, advantages, again, it depends on the province you're in, but typically a much smaller, lower tax rates on the first 500,000 of earnings. In Ontario, it's 12.5% tax rate. There's a better mechanism available in corporations that allow for accumulation of capital and reinvestment. So if you're only paying 12.5% on the first 500,000 of earnings, versus if you're earning that income personally and paying 45 to 50% on that earnings, you'd have a lot less available for reinvestment. So there's a deferral ability of anywhere close to up to 40% available. That provides more after-tax dollars available to the corporation for reinvestment in that case. Low cost of financing, interest deductibility, principal repayment with greater after-tax dollars, really the same point there pretty much, just better ability for deferral. There's limited liability for corporations, so the shareholders aren't going to necessarily be sued, or they don't participate in the liabilities of the business unless the banks provide for personal guarantees, or if you're dealing with things like HST or source deductions, that can attract to the directors of the corporation. The ability to freeze value by taking back fixed preferred shares. So unlike a partnership, if somebody's interest in the real estate continues to climb, there's no way of capping that. Whereas in a corporation, you do have the ability to do an estate freeze by fixing and locking in your value. So it gives a little more flexibility for transition of corporations to the next generation. Another advantage is it just allows the generation 3 to use their share of the profits on a pre-tax basis to help potentially fund a buyout. So in some of the more complicated restructurings or transitions, it actually is just a little more flexible for the next generation, giving them more advantages, more after-tax dollars to be able to fund the purchase. Disadvantages, generally higher compliance costs, just given the accounting and legal costs involved to maintain them. There's often inflexibility in terms of allocation of assets, so more difficult to divide later. So if everything's in a farm corporation and there was a need to divide a farm and give one farm to one child and another one to another child, it's a little inflexible that way. And as I said, if it was owned personally, you could just make that transfer, but through a corporation, it involves a bit of reorganizing to do it. And shared liabilities, I mean, there is more shared liability, I guess, from the director's perspective, not necessarily with partners in this case, but I guess there is a shared liability if you're pooling assets together within one corporation, but not to the same extent there is as joint and several liability with partners.
Okay, part of what we ended up going through with the Hunter family, we presented some of the options to them, and then we wanted to sort of establish what were some of the key goals that they had when they saw this information. So the first one is to have equal ownership for Maggie and Mark itself. Compensate Mark for the sweat equity that he had from basically birth right through until his current age. He's always been on the farm. Maggie to contribute investment to equalize between her and Mark, and ownership, if desired, for Generation 4, which may include Matthew's children. So again, building that option in there without attaching major hurdles for them, especially from the tax side of things. And then the farm to provide income for Mary and Bruce for the long term. So recommendations that were taken forward to look at estate freeze, allow the common shares from the corporation to be issued to Maggie and Mark to limit the growth in Bruce's shares, and consider establishing a family trust to acquire common shares. This would allow flexibility in transferring ownership to Generation 4 and provide that pathway for the long term and allow a tax-free rollover that Matt had talked about earlier. And look at share buyback, establish a plan to purchase some of Bruce's shares during his lifetime, providing additional income to him as well. Preferred shares, gradually gift from Mary and Bruce to Maggie and Mark, and then review the cash flow to ensure it can support amount of share purchases over time, which is a key part of the plan. The capital gains exemption, how to use it, how much do we maximize it, would all be part of the calculation. And then personally held real estate, as Matt had talked about earlier, keep out of the farm corporation if it's gifted. Otherwise, lose ability to claim future capital gains exemption on that asset or on that real estate. If purchased, Generation 3 should consider using corporation to fund the purchase with their share of farm profits, providing greater after-tax dollars available to fund. So with the transition plan, the process after the basic plan has been presented, it's reviewed and updated annually. We look at the cash flow of the farm. Is it adequate? Do there need to be changes made? We look at changing income needs. With Mary and Bruce, depending on income coming out of this, is it significant or is it enough? They need as much? What's changed? Tax rule changes, again, trying to make sure everything fits within the rules themselves without attaching any additional tax. Changes in the family. Is there other marriages, or new children coming in that do want to become part of the family or of the farm? Then have to make some changes for that basis. The farm life financial is a member benefit partner with Ontario Federation of Agriculture. So we provide 10% discount on all succession planning fees to its members. There is a complimentary consultation, and we have regional workshops annually spread out across the province, and we have follow-ups with the family for the next 2 years after the transition plan is presented. That's the end of the presentation. We're open to questions. We'll take the questions as they'll come in that have been submitted from the beginning. Thank you.
Thanks, everyone. Okay, I think we have some questions that have popped up in the Q&A section that Earl and I will go through and answer. First question is, can you explain a little more about what probate exposure means? So what we mean there is certainly in Ontario, I believe BC as well, in certain provinces, we have the imposition of probate fees or a state tax, like administration tax that can apply to the value of assets that are administered through a will. And those fees are applicable the minute you try to get a will approved in the court. And I know in Ontario it can be almost up to 2% in terms of the overall estate value of the assets that are being administered through the will. So some of the strategies have to take that planning into consideration. You know, certainly gifts during lifetime would help the family avoid probate. If they die holding the assets, they may have to pay it, but if they gift the asset during lifetime, they're obviously not going to have to worry about it. You know, there's other strategies we look at too, including dual will strategies, multiple wills. Really, they're mostly available for shares of private corporations or partnership interests, and they may not help with the land. Second question, do the tax rules of transition change if the farm corporation is renting all of its land, not actively farming? Yeah, that's that one's a tricky one. It's I mean, you have to be careful with that because some of the conditions, like the conditions to be eligible for rollover, is that the property has to meet the principal test rule. So more than 50% of the land and typically the period of ownership, the property has to be used principally in the business of farming. And as well, it's important, you have to look at the whether there's a qualified user there as well that makes it eligible for the rollover. So it is a bit of a tricky analysis that you have to get into to take a look at and make sure you qualify. Sometimes it doesn't. Sometimes there's cases where it may not. Certainly, land rental itself is not considered farming. So that is unless it's actually being rented to a qualified user. So there's a number of factors there to look at. In a case where the land may have been rented for 15 years and owned for 25, then and that's not to a qualified user, then it may not qualify. So yeah, be certainly careful in making the assumption that it does in that case. Sorry, I'll keep reading these, Earl, unless you want to jump in on any of these questions.
No, you're doing it well.
Another question, who should have the final say when deciding which tax approach to take? Should the farm owner make this decision, or should it be discussed as a family unit? If so, how do you suggest handling these discussions? So that's a really good question, and it is one that we have to we're always mindful of and trying to involve everybody. Certainly, we always have a bit of a saying that you shouldn't let the tax tail wag the dog. I mean, it's best to ensure that everybody and all the goals are outlined first up front. Everybody's clear on what direction they want to take, then, we look at the tax implications of achieving those goals. Certainly, big part of that discussion is going to be the transferor, because the tax implication is going to impact that person first. But I'm always in favor of including, the next generation or the transferees in that discussion to make sure they understand the implications of the plan and everybody's on board, and that they're in agreement, because there is some implications to them as well. For instance, if we decide we're going to use a capital gain exemption on a transfer, certainly that can benefit the next generation, but it may cause loss of old age security and supplement. And so it's important that everybody understands the implications and agrees with whatever plan's imposed. Are there any other things to consider for partnership transfers from a 3-generation perspective? Yeah, this can be tricky. Certainly, we see a lot of cases where mother and father might still own it. Their kids have been active in the business, in the farm business for many years, and then they're already getting 3rd generation involved. I think there's a lot of things there to consider. I mean, certainly the tax rollovers that are available, typically it can go from grandparent to grandchild, so it is possible to skip down to the 3rd generation if they want to include them in ownership. But of course, there's a lot of things packed into that consideration. For instance, if there's family law issues involved with each of them that have to be considered, responsibility at that 3rd generation level. So we've had cases where we have seen farms transfer and skip that 2nd generation right to the 3rd generation. But we've also seen cases where it made sense just to take it generation at a time and transfer to that 2nd generation. Can you comment on what is involved to transfer assets from a 2-way partnership to, say, a new 4-way partnership? Yeah, that can be done in a few different ways. It is possible to admit new partners into a partnership. So it is possible just to bring in new partners into an existing partnership, and that can be accomplished on a tax-deferred basis. Sometimes it depends, but sometimes it can be beneficial to dissolve an existing partnership, which can be done on a tax-free wind-up basis, and roll assets to a new partnership involving the 4 partners. So there are a couple different ways to accomplish that. Question for Matt. Would you suggest a corporate reorganization to enable spouses to use the lifetime capital gain exemption, creating 3 share classes for each spouse? First fixed value, 1 million, second fixed value, remaining freeze value, and then 3rd class being commons, ultimately to enable opt-out of rollover at the time of the first spouse's death on the first fixed value $1 million, so as not to lose the capital gain exemptions for situations where farm values greatly exceed lifetime capital gain exemption, and roll over all remaining shares. I know this might be too specific, but wondering if you've come across. Yeah, we have. I just, I take it in this case, we're not talking about 1 transfer with 3 spouses, but 3 transfers with each with a spouse. That's a joke. And unfortunately, I can't hear anybody laughing. But, in a case like that, I know what you're getting at. There is an opt-out, so you can elect out of certain shares that roll over to a spouse on death, claim the capital gain exemption, and allow the balance of shares to roll over. It is possible to actually elect out over on particular shares. You don't, just because they're of the same class doesn't mean you can't let some shares roll over and that you can't elect out on others. The point of this question, and it's a really good technical question, but it is one that really involves some need for estate planning and maximizing the use of everybody's exemptions along the way. So there is that option where you can elect to use an exemption on some shares, and allow the balance to roll over if you decide. I agree. I think, what you're suggesting in this question is it's a lot cleaner, and it allows you to designate which shares specifically, what class of shares are going to be elected out. The more upfront planning you can do in a case like that, always the better. Corporate advantages. Gen 3 uses profits to...
Oh, there's a question right before that, Matt.
Oh, sorry, I'm jumping out. Yep. We are not incorporated and own 4 farms with land and houses. Each of our children live in the houses, and we also live in one. They each farm their 80 acres with some joint equipment. The question, we have put their names on a part of each farm with minimum down payments. Can we now just leave the farms to them in our will, or will they be taxed? Yeah, so, you have to, it sounds like they're actively used, they're regularly engaged on a regular and continuous basis in this farm business. And, there is a question sometimes as to whether houses are actually qualified farm property. But, we've gone through some analysis in the past, and, if it's part of an overall parcel that's used in the farm business, generally the house is also going to be included as qualified farm property. So the rollover would be available potentially both during lifetime and on death. So it can go through an estate. I would just be cautious, check with your lawyer on that to make sure you're not, depending on what province you're in, if you're subject to any probate exposures in this case, which, if it's substantial, you could also look at doing a transfer during lifetime. But, as long as the test is met in terms of the principal use and the qualified users, you should qualify for rollover to each child. Just one thing to watch. We watch this, we see this happen a lot. Each child ends up with a partial ownership in each of their siblings' houses, in each of their farms, and it could actually minimize their ability to claim principal residence exemptions. So sometimes, it may not be the best strategy to have them own a piece of each, and whether it's possible to look at, does it make sense for each child to have their own respective houses and farms? And, we'll even look at whether, severances are possible so that they can at least own their own house. Okay, the next question here. Corporate advantages. Gen 3 use share profits to fund buyout. So this refers to the slide where we were talking about the use of corporations and whether, the availability of funds to help fund a buyout of Generation 2. And in this case, Generation 2 is freezing their shares. And so they can either look at doing a share sale or redeeming those shares. And if Gen 3 borrows through the corp, would these loans enable buying out or redeeming Generation 2 shares, and would the interest be deductible to the corp? So there is, that's something to watch. So certainly with the share redemptions, using funds within the corporation to fund a share redemption, that allows them to use money pre-tax to be able to fund the buyout. You do have to watch to make sure the interest is deductible, because as long as there's retained earnings in the corporation, CRAs of the view that any borrowings used to fund share redemptions will be considered deductible. In other words, the interest on those loans will be deductible. If there isn't retained earnings, then there's a risk that it may not be deductible to the corp. Certainly, buying shares, purchasing shares. I mean, one thing you have to watch is just how that's done, because you can't just borrow money out of a company and then use that to fund a buyout of shares personally. It might actually be necessary to use a holding company, and then, of course, depending on the relations of the individuals involved, there are some other rules. So it's very complicated when you get into that level of planning. But certainly if they were to borrow through a holding company to acquire shares, they could later amalgamate their companies, place the debt all internally, and basically accomplish the same thing. I think you just have to be very careful if they're using a holding company to buy shares from a related person and they're claiming a capital gain exemption. That's something that's not allowed without causing a deemed dividend. So there's some caution on that one. Okay, how would you take advantage of the principal residence capital gains exemption within the family? For example, one family member takes over the house. Yeah, sometimes, it really varies case by case, but, oftentimes what we'll look at is if, let's say first generation selling the next generation, and they want to realize some proceeds on that sale, but they of course want to maximize use of the exemption. So oftentimes what we'll do is we'll have them, sell the principal residence, make the principal residence designation, be able to get an appraisal, carve out what the value of the residence is. And that allows the vendor to claim their principal residence on that portion of the gain. If somebody's just moving in, what they actually will have to do is they'll have to make separate designations in the tax return. So certain properties that are being transferred on a rollover basis can be gifted. They would actually have to, elect out in the case of the principal residence and make that principal residence designation in their tax return.
I think that's it.
Earl?
Yeah.
Okay, well,
thanks everyone. Really appreciate the opportunity to talk to you today.
Yeah, thanks everybody.